Hi, I'm Alex and welcome to the channel. In today's video, I want to talk about the real reason why we saw the increase in the markets from March through to a couple of days ago, despite all of the negative economic data coming out of basically every country around the world. And a quick spoiler, no, it's not Jerome Powell's money printing machine. Yes, while certainly people have invested their stimulus checks into the markets, retail investors make up such a small portion of the market that this really doesn't move the needle in that way. Now, this video is not going to be for everyone and I apologise for that. The answer is based around technical finance. So if that's not your cup of tea, then I won't waste your time, but I do promise the next videos will be focused back onto other stocks and how to become a better investor. However, if you are interested in knowing what it is, let's get straight into it. It's super simple. It ultimately comes down to the really low interest rates on government bonds, from 0% all the way through to negative yields on these bonds. But you're probably asking, how does that make sense? You're talking about bond yields, not equities. Let me introduce you to CAPM, the capital asset pricing model. Ultimately, this explains the allocation of money across different asset classes and explains the relationship between risk and reward that investors are looking for. So let's take a look at the formula. RA is the required return which you as an investor need to be compensated for in order to hold that asset, whatever stock or share that may be. RFR is the risk-free rate. This is the return that you would expect to get from a long-term riskless security such as a long-term government bond. And this is the important bit which we'll come back to. B, or beta, ultimately what the beta is it's the perceived volatility of that specific stock versus the stock market. A beta of 1 means the stock moves in line with the stock market. So if the stock market goes up 10%, that stock would go up 10%. A beta of greater than 1 would be a stock that went up by more than 10%. And a beta of less than 1 is one that's less volatile than the market. If the stock market went up or down by 10%, that share would go up or down by less than 10%. And MRP is the market risk premium. And this is the additional return that's required by an investor above the risk-free rate to be compensated for the risk of holding stocks instead of risk-free assets. So then why does the decrease in the interest rate on long-term government bonds impact the equity market in this way? Well, let's follow that through the formula. A decrease in the interest rate on long-term government bonds, in this case the risk-free rate, means that the required return for holding stocks decreases. This then flows through into your weighted average cost of capital as part of your discounted cash flow analysis. And the lower WACC, as a result of the lower risk-free rate, ultimately means that the intrinsic valuation of the stocks increases. Look, I know that explanation sounds quite confusing, but ultimately what it means is that the reduction in these government bonds has driven a reduction in the overall discount rate, the overall cost of capital for investors, which in turn drives up the price investors can pay for stocks and is ultimately the reason why we've seen this rally in the stock market. So it's not people spending their stimulus checks in the market, and there you have it, a technical answer as to why that's happened. Now look, ultimately, I'm still a believer in that we will see a further correction in the market. I think a lot of bad news is still to come. Clearly there's some very bad economic indicators coming out, and ultimately this is going to be reflected in companies' performance. I do think in the near term a correction in share prices. If you want to hear more about this, check out my other video and I'll put the link in the description below. My focus now is ensuring that my portfolio is as recession resilient as possible and that I'm in a good position to ensure that I have strong portfolio growth coming out of that recession. And I have videos coming soon on how exactly you can learn to do that as well. So look, I hope you found the video interesting. I know it's a little bit different from some of the other videos I've done, but if you have, please smash the like button, please subscribe to the channel. It's all really, really appreciated. And thank you so much for watching. I'll see you in another video.